and gentlemen, good day and welcome to the Q3 and 9 months FY24 earnings conference call of EPAC Durable Limited hosted by Valorum Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Mr. Anuj Sonpal from Valorum Advisors. Thank you and over to you, sir.
Thank you. Good afternoon, everyone, and a very warm welcome to you all. My name is Anuj Sonpal from Valorum Advisors. We represent the investor relations of EPAC Durable Limited. On behalf of the company, I'd like to thank you all for participating in the company's earnings call for the third quarter and 9 months ended of financial year 2024. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now, let me introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We have with us Mr. Bajrang Bothra, Chairman and Whole-Time Director, Mr. Ajay D.D. Singhania, Managing Director and Chief Executive Officer, Mr. Sanjay Singhania, Whole-Time Director, Mr. Rajesh Kumar Mittal, Chief Financial Officer. Without any further delay, I request Mr. Bajrang Bothra to start with his opening remarks. Thank you, and over to you, sir.
Thank you, Anuj, and good afternoon, everybody. Welcome to our first ever earnings conference call to discuss the performance of the third quarter and the year-to-date results of the financial year 2024. In the interest of some of the people who are new to the company, let me first start by giving a brief overview of the company. EPAC Durable Limited is the second largest room air conditioner original design manufacturer, ODM, in India, in terms of number of indoor and outdoor units manufactured in fiscal 2023 through its ODM route. Our journey started in the year 2003, where we started as an original equipment manufacturer for RAC brands. Over the years, we have consistently grown by adding new customers, increasing our capacities, and backward integration. The expertise of EPAC Durable lies in manufacturing a diverse portfolio of room air conditioners in small domestic appliances, we call it SDAs. We cater to all aspects of room air conditioners and small domestic appliances value chain, including extensive ODM and OEM service across our product lines. We are a customer-centric company where business is driven by a focus on continuous innovation and operational efficiency. EPAC Durable works jointly with the customer team and customizes the products according to different client requirements. Our strong manufacturing and design capabilities, including developing, designing, and manufacturing models of RACs of various designs and technical specifications. Further, the current RAC product offerings enable the company to offer more customization to RAC brands in terms of completely built-up units or IGUs and OGUs separately. Our integrated manufacturing facilities help us manage operational costs and logistics efficiently. In line with our focus on bringing in operational efficiency, our manufacturing operations involve a high degree of automation, which reduces the margin of error and manual inefficiencies. Our manufacturing facilities are also strategically positioned to facilitate product transportation to customers across India. We have 3 manufacturing facilities located at 1, Dehradun, Uttarakhand, 2nd, Bhiwadi, Rajasthan, and 3rd, Sri City, Andhra Pradesh. We strongly believe in staying ahead of the curve and the key role that research and development plays in product development. We have 3 dedicated R&D centers with over 57 employees that are equipped with modern infrastructure such as endurance test labs for RACs and SDAs. Our R&D activities focus on the development of new products, optimization of existing products, and manufacturing methods, process improvements, environmental protection, and energy efficiency. With the help of our R&D department, we have 1 registered patent, 2 filed patents, and 10 registered designs in India. Due to these strong operational capabilities, EPAC Durables today is one of the key ODM for most of the major brands. We are also constantly expanding our product offering in both RACs and SDAs and have also invested heavily in expanding our capabilities and capacities to cater to the growing demand. Apart from this, we have a highly experienced board of directors with 2 nominee directors from ICICI Venture Fund and Afirma Capital, 2 well-known private equity funds that invested in our company in 2021 and 2022 respectively. We also have a strong and highly professional management team that carries out the vision and mission of our company. Our management team's focus is not only to grow ahead of the industry and peers, but more importantly, to be highly profitable while improving operational efficiencies. This is clearly visible by our company's performance over the years. Now I will request our CFO, Mr. Rajesh Mittal, to brief you on the financial highlights, after which our MD and CEO, Mr. Ajay Singhania, will brief you on the key operational highlights. Thank you.
Thank you, Bothraji. Good afternoon, everyone, and welcome to this earnings call. Let me give you some of the key financial highlights of the third quarter, followed by the 9 months ended of financial year 2024. For the third quarter under review, the revenue from operations increased by around 1% on year-on-year basis to around rupees 279 crores. The EBITDA was reported at around rupees 24 crores, which increased significantly by around 439%, with the EBITDA margin reported at 8.49%, exhibiting a growth of 689 basis points year-on-year. The net profit stood at around rupees 5 crore, which is a loss of around rupees 6 crore in quarter 3 of last financial year, with the PAT margin for the quarter being at 1.76%. For the 9 months ended for financial year 24, the revenue from operations stood at around rupees 894 crore, which declined by around 1% on year-on-year basis. The EBITDA was reported at rupees 61 crore, which grew by 56% on year-on-year basis. The EBITDA margin stood at 6.78%, that grew by around 247 basis points year-on-year. The net profit stood at around rupees 8 crore, which is a loss of around 1.40 crore in 9 months ended of the financial year. I am happy to inform you that the company has significantly reduced its working capital days from 91 days in financial year 23 ended to 51 days at the end of quarter 3 2024. Furthermore, our debt position has also reduced through internal approvals and also through increase in the net worth of the company, resulting in a reduction of debt to equity ratio from 1.58x in financial year 23 ended to 0.73x in quarter ended financial year 24. Now I will request our Managing Director and CEO, Mr. Ajay Singhania, to brief you on the operational highlights.
Thank you, Rajesh. Good afternoon, everyone. It's a pleasure to welcome you all once again on this first ever earnings call by EPAC Durable. So like Rajesh mentioned, I'll just reiterate that our revenue growth for this quarter and year to date remained flattish. This was mainly because of lean summer season at the beginning of this financial year, which resulted in demand disruptions in Q1 of this current financial year. This led to significant inventory piled up in the system with the brand, which was duly liquidated by the brands in quarter 2 and quarter 3 of the financial year. So as most of the brands have reported significant improvement in their results ended quarter 3, and the commentary from the brands is also very evident that they had a strong Q2 and Q3, which is a good sign that most of the brands have liquidated their inventories at the end of Q3 of this current financial year. So with this improved demand now, it seems that the upcoming season and the quarters will be significantly better for us and the industry as a whole. Despite the market conditions for ended quarter 3 FY24, we have shown a strong bottom line performance this quarter with over 400% growth in EBITDA on a year-to-year basis. We are also very well equipped to cater the upcoming season as we have started manufacturing at our new facility in Sri City, Andhra Pradesh, whereby we have increased our capacity 50% on a year-on-year basis. Furthermore, we continue to work towards enhancing our product portfolio by adding new product categories. Since January 2024, we have added and started manufacturing of a new product category, namely air coolers. We will continue to expand our product portfolio in line with our clients' requirement. Additionally, we have also started manufacturing and supplying of components of plastics, copper, cross-flow-fan, sheet metal from both Bhiwadi facility as well as the new Sri City facility to certain major brands. Since Q3 FY23, the company has increased its in-house manufacturing of additional components like cross-flow-fan, which is import substitute, PCB controller, which again is import substitute for both RAC as well as the small domestic appliances. We've also started manufacturing in-house of universal motors for mixer grinders and induction coils. This backward integration and enhancement in manufacturing capabilities will further improve the margins of the company in coming quarters. In FY24, we have also added various new clients, thereby diversifying our client base, and also we have increased the wallet share with existing customers. We'll continue to diversify our product mix and expand our client base as we prepare for our next phase of growth. In conclusion, we are very excited for this new chapter in our company as a listed entity. Our year-to-date financial performance is a testament on how we have significantly improved our operational efficiencies by reducing our working capital days and also our debt level despite significant capacity expansion. With our continued focus on growth while improving profitability, we are confident of delivering sustained superior performance over the coming quarters. With this, we now open the floor for Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Anirudh Joshi from ICICI Securities. Please go ahead.
Yeah, thanks, sir. Thanks for the opportunity. Sir, one is definitely the margin expansion trajectory is very encouraging, and definitely the efforts in terms of the backward integration or the new plant utilization level may also lead to better margins. So you would like to point any number as far as FY25 is concerned, where should we in a way benchmark the margins per se at? That is question one. Secondly, if you can also indicate the total PLI as well as PLI benefits booked in 9 months FY24 as well. And the third and last question is, how do you see the season panning out? Because some of the competitors have in a way reported relatively muted numbers in December quarter, but our performance has been very strong. So just from the industry perspective, how do you see the upcoming season panning out? Yeah, that's it from my side. Thank you.
Thank you, Andrew. Thank you for asking. So as we have reported numbers on a quarter-on-quarter basis, the EBITDA margins from 1.6% as of quarter 3 22 has improved to 8.5% in quarter 3 FY24. At the same time, on a year-on-year basis, you can see a 9-month basis, the EBITDA margin is close to 6.9%. So traditionally, we have maintained a EBITDA margin of 7 to 8%. Going forward also, our guidance is that we will try to maintain this in this similar level. This is in relation to the EBITDA margin. In terms of the PLI benefit which has been accrued for the year end, for the 9-month ended FY24, it is close to 10 crores of PLI profit which has been accrued. And in totality, the PLI benefit which the company is permitted to get is around 30 crores for the entire financial year of FY24. So out of this 30 crores, 10 crores has been accrued in the numbers. So for your last question about season spanning out, see, like I started with my opening comment that despite the erratic Q1, Q2, Q3 has given respite to the industry, and as a whole, the numbers are very encouraging in the sense that most of the brands seem to have liquidated their inventories which was carried forward from Q1. And as we enter into the main season for this calendar year of 24, all the brands have entered with minimum inventory, which means that the amount of fresh production required for the season is going to be significantly better, and this is an encouraging sign for us.
Sure, sir. This is very, very helpful. Thanks. Just one TLI benefit, the turnover link incentive for Bhiwadi plant, if you can share that number as well. Yeah.
The company has currently not been granted any TLI benefit. The policy was announced by the Rajasthan government, but then the government change happened, and so there has been no conclusion, and it has not been currently taken. The company has currently not taken any benefit or not received any such commitment from the Rajasthan government.
Okay, sure, sir. Understood. Thank you. Thank you.
Thank you. And the next question is from the line of Nyan Thakkar from Ashika Institutional Equities. Please go ahead.
Oh, hello, sir. Congratulations and thanks for the opportunity. Sir, for the 9-month ended, can you help us with the AC sales breakup and other products breakup, revenue breakup? I would like to understand, and as well as the margins.
See, then in terms of the revenue breakup, broadly I can tell you that the revenue from AC is close to 83% and 17% from non-AC. That's broadly the 9-month ended result, which is almost again quite similar to what it was in the previous year. Previous year it was 88% from AC and almost 12% from non-AC. So there's no significant change in that terms. And in terms of margins, we are not doing any segmental analysis. So overall margins have been reported for the year ended for the 9-month ended, the overall margin is 15% for the current financial year, whereas last year for 9-month period it was 13%. So on a 9-month basis, we see 2% improvement in overall material margin.
Got it, sir. Sir, it's okay even if you are not giving us the exact number. Can you just help us understand whether the RSP margin would be more or the SDS margin would be more?
Since those numbers are not reported or are not measured in that sense because of the seasonality. So we need to understand that it is not a month-on-month similar business. So both businesses are on a different level at different quarters. So those numbers we feel are not very correctly indicative of the company's performance. However, having said that, what I can definitely share with you is that for both the products, the scope for improvement in margins is by virtue of backward integration. I mean, higher the backward integration, the better is the material margin we can accrue. And in this direction, in last 9 months, the amount of in-house manufacturing, which I stated earlier, we have increased, like the controllers, the universal motors, and the crossover fans and coils, and so all this is what is helping us definitely improve our overall contribution, our overall material margin.
Okay, sure, sir. Thank you.
Thank you. And the next question is from the line of Bhumika Nair from DAM Capital. Please go ahead.
Yeah, good evening, sir, and congratulations on the sharp turnaround versus last year and improvement in margins. So my first question is related to the room AC segment. As you rightly mentioned that, inventory levels of the brands have now normalized and fallen quite sharply. placing it in a very apt situation for the upcoming season. So how are you seeing the ordering activity? Are you starting to see an uptick? And, given that, we are already sitting in the month of Feb, how is the ordering activity for the upcoming season looking at? If you can give some qualitative sense in out there, and how are we adding new clients? What is the wallet share gains? Something of that sort would really help us understand better.
Thank you, Bhumika. So, yes, so I agree with you that we are sitting on the mid of the quarter 4. So currently, as we can see, the demand uptick is definitely better, and especially with us putting up additional 50% capacity. So, now we are equipped with 50% extra ammunition to fire during the peak season. So now 6 months are very critical, as we all know that the maximum amount of manufacturing happens during the 6 months. And with EPAC sitting with extra 50% capacity, we definitely aspire to utilize the newer capacities and the old capacities and give better service to our customers in terms of their increased demand. One, and in terms of the new client additions, there are 2 things which the company has done in the recent 9 months. One, we have added newer SKUs. So we have recently invested in new toolings and new chases for the smaller capacity of RACs like the 0.75 ton and 1 ton, and then similarly the larger sizes like 2 or 2.5 ton. So for this, we believe that we now have the capacity and capability to accumulate the quantities of different customers together, because both of them standalone might not make much sense for a single brand to invest. So when we consolidate the quantities of several customers, it definitely becomes a very viable proposition for us, and we are definitely getting good response in both these new categories which we have introduced. Similarly, we have also added a lot of mid-tier customers who are also growing very rapidly. Similarly, a lot of larger customers also who have their own manufacturing capacity. Because of the market size expansion, we see them to start outsourcing at a higher level as compared to the previous years.
Got it. So basically, are we seeing an increase in the ordering activity versus last year, given that, some of these brands have, announced their own capacities, and some of your peer set itself have also kind of highlighted that next couple of quarters could be challenging given their own, the brands putting up their own capacities. Are we seeing something like that, or are we continuing to see good ordering activity?
Definitely there's no denying the fact that some of the large brands have increased their capacity for the coming season. And so this has kind of changed the overall industry dynamics with, it's basically the 3 larger customers who have now increased capacity. We all know that information is there in the public domain. So this has kind of impacted us also. So one of the larger customers for us, who was largely dependent on us as of last year, this year we have seen a significant reduction in his volume to the tune of almost, let's say, 200 plus crores. But at the same time, having said that, we have been able to make up the lost business by adding newer customers and newer SKUs. So with this, what I'm trying to convey is that it is a dynamic industry and a dynamic situation where customers will add capacities as and when required. The intent of the customer, we believe, is not to take away business for us, but it is more to sustain their own bottom line. And hence, the dependence on us will also continue, which might fluctuate on an year-to-year basis, but at the same time, the brands and the OEMs are here to coexist for a longer duration. So it's more of a strategic relationship.
Sure. So the other thing is on the component side. We were looking to scale up on the components this year. And, so just if you can talk about how that aspect is kind of playing out. And my last question was related to the earlier question where you spoke about the TLI not being granted as yet. But despite the government change, etc., we are looking forward to that approval coming through, and for us at a later stage being able to get those benefits.
Sure. Okay. So in terms of component space, if we look at, thankfully in the last 9 months, we have been able to attract customers with our manufacturing capability now being near to the customer's location. So at both Bhiwadi as well as Sri City, we have started in a small way supplying components since last 4-5 months, and going forward, the inquiries are also better. So there is a lot of development and approvals in process. So this component business definitely is slightly a long lead time item, because some of the components are also customer specific or are manufactured as per customer's drawing, so the lead time to get approval is slightly longer. But that's a work in process, and we have definitely started getting that attraction, and the suppliers have started for certain items like cross-flow fans and certain plastic parts and others. And the thing is, our PCBA controller assembly line, which we have, the PCBA line, which we started originally for our captive consumption, now is also getting good traction from the customers for doing their for making the controllers for their ACs or similar other appliances. So that's another opportunity in pipeline, which we believe will definitely materialize in next 4 to 5 months. Now, in terms of TLI, your second question, yes, TLI by the Rajasthan government has not been granted to us as of now. The application is in process, and once that comes, it will be to the tune of 1.8 to 2% of the total revenue, and I believe it is 1.25x of the overall investment what we have committed in Rajasthan. That's over the next 10 years. So, but we are still to get that entitlement certificate. Hopefully, we should get it within next probably within next 45 to 60 days.
Got it. So if I may just
incremental benefit which will accrue from the Rajasthan.
Absolutely. Point taken.
But we haven't made any provisions of it as of now.
Understood. Sir, if I may just squeeze in one last question on the cooler business. We had kind of done an announcement saying that we've entered that business. If you can just talk about what is the potential of that particular segment, how quickly can volume scale up, and what kind of revenues can one look at, or in margin profile, how it is comparable, etc. If you can just give some qualitative understanding around that business, would really appreciate it. Thank you.
So Bhumika, in terms of cooler, one thing which is very encouraging about the cooler industry is that the penetration of coolers is almost 17%, which is twice that of an air condition. And the 17% when we talk is that for the organized market. We all understand cooler is also large and organized market is there. So the brand market is 17%, double of AC, and this again is a 10-month manufacturing industry as compared to, let's say, AC being a 5-6 month predominant manufacturing industry. So this helps us improve our asset utilization, because we get an opportunity to utilize our assets for injection molding, especially for 10 months. So in terms of the manufacturing capability, it is almost similar to that of our air conditioning facilities. So, and in terms of opportunity, we started with one large customer, and going forward, we are looking at the, again, top 4 of the brands. So is what we are eyeing at for the overall cooler. And in annual year, if I look at, we definitely look at the revenue of 80 to 100 crores in next 16 to 18 months period in the first year.
Got it, sir. This was very helpful. Thank you very much, and wish you all the very best.
Thank you, Bhumika.
Thank you. Ladies and gentlemen, you may press star and 1 to ask questions. The next question is from the line of Utkarsh Maheshwari from Reliance General Insurance. Please go ahead.
Good afternoon, sir. Hello?
Yeah, good afternoon, Utkarsh.
How are you, sir?
Yeah, very good, very good.
Numbers are showing some good traction. Just a small doubt I had, because last year we did roughly like 1,500 odd crores of revenue, and you mentioned that there has been some capex done by your largest customer. So do we think that this year we should have a similar, in the 9 months we have not grown at all in terms of revenue, the aggregate revenue. So do we think that there is a possibility of, some kind of a drop versus last year in the full year numbers, or it will be recouped and there could be some growth possibility coming in?
See, Utkarsh, like you rightly said, last year total number was 1,500 crores.
Yeah.
So which means in the last quarter itself, the overall revenue was close to 600 odd crores.
Uh-huh.
And what I'm trying to say is the 50% extra capacity. Now we have ammunition to do a 1.5x kind of a thing. So that definitely depends on the order book we have. Currently, the traction is good. At the same time, a unique thing which we have seen for the overall AC demand, the way it has ramped up for the current season, there is definitely a delay of 30 to 45 odd days compared to the previous years. So because of the a delay in the overall inventory getting liquidated, we see that the overall seasonality picking up in terms of manufacturing has been delayed by 30 to 45 days as a whole. So that's the kind of indication or this thing what I can give you. At the same time, the impact...
So there is a delay, possibly what you are saying.
Sorry?
There can be a delay of, because of the resultant of delay, there can be some spillover of revenue from Q4 to Q1.
Yes.
That is for the like-to-like. And how about that order which, I mean, the one of your largest customer who has started his own factory, and so will that see some kind of impact on your this side?
So, Utkarsh, like I started saying, we have already been able to neutralize that impact by adding newer clients and newer product segments. So we have been, we were preparing for it, and so we have been able to neutralize that customer's shortfall.
Okay. And I think the new introduction in terms of small appliances and all, that should start contributing meaningfully from next year, right? The components and
the season starts from end of June, July, so those appliances will show uptick from the end of Q2 for the next financial year.
Okay, fair point. Thanks a lot. I'm done. Thank you.
Thank you, Utkarsh. Thank you.
Thank you. And the next question is from the line of Shiva Sai from NSVR. Please go ahead.
Hello.
Yeah, hi Shiva.
Hi sir, thanks for giving the opportunity and congratulations. And my question is, when your customers are expanding by backward integration, like setting their own plants, what is stopping you from creating a brand, one brand of AC and launching directly selling the ACs to the customers?
Shiva, the way I understand the question is, you are asking that is EPAC Durable planning to bring its own brand? Is that the question?
Yes. When your customers are planning to make backward integration and set up their own facilities, you can also plan to expand your business by forward integration directly to the customers. You can launch a brand like that. If there is a scope of some manufacturing was delay, then you can do it.
I really appreciate your thought. At the same time, see, the core competence of EPAC Durable is manufacturing, and this is the way we have grown, and this is what we have mastered. So, although the brands are putting up capacities, they are increasing their capacities, we understand that. But what we have been telling you all along is that brands are not putting up capacities to take away business from OEM. It is a strategy which is a long-term thing wherein both of us will coexist, and this is how traditionally the market has behaved globally. So both OEMs and brands coexist because there is a lot of interdependence. It is not possible or generally possible for a brand to manufacture everything it wants under it on its own. So it's a mutual interdependence. So these things might have a short-term impact of a newer capacity coming in, definitely. So maybe this thing, what we understand is over next 3 to 4 quarters, the dust will settle down, and then we will see a more clearer picture emerging on how the brands are behaving.
Okay.
Shiva sir, does that answer your question?
Yes.
We would like to remind participants that you may press star and 1 to ask questions. The next question is from the line of Dinesh, an individual investor. Please go ahead.
Yeah, good evening, sir. Thanks for the opportunity. So my first question is about the debt part of that part in the balance sheet. So post repayment of that 80 crores which was raised from the IPO proceed, what can be the average cost of interest rate for the remaining debt, and any possibility of giving a interest cost number for FY25?
Okay. Image, in terms of the IPO proceeds, those numbers are not accounted because the results are for the December and 23. So the IPO proceeds came to the company only in the end of January. So those numbers are not shown in the current results declared. Having said that, yes, like we committed that the 80 crores of the total IPO proceeds will be used towards debt repayment, the long-term debt repayment. That has already been done as on 31st of January. 30th we received the funds, 31st January the debt was repaid. So that has been duly utilized.
Yeah, I'm asking about what will be the average cost of interest rate for the remaining debt that's there in the balance sheet, roughly average. Okay. For the entire debt.
The average will be between 7.5 to 8.25% because in recent years the RBI has increased the repo rate and everything. So in last 9 months we see the cost of funds has moved up slightly. So going forward, depending on the RBI policy, definitely the lending rate might increase further or may not. So we can't comment on that. So that entirely depends on the RBI's. But our weighted average cost of fund as on date is between 7.5 to 8.25%.
Okay, sir, got it. And my second question is regarding the coming season. So previously in last year there was a huge buzz that El Nino impact has been there on the country. So because due to that, did we see any are our Q1 numbers are in line usually how it will be, or due to just that El Nino impact, did we see any uptick in the sales? And what can be are there any projections for this year too regarding that El Nino impact? So how can the business pan out for this going ahead Q4 and Q1?
In terms of the seasonal requirement, the entire industry is very positive that for the coming season, the market is destined to grow by at least 15 to 20% on an average. So that's the way the industry is preparing, and this is how the order book has been piled up for us. So everybody is expecting a good season this year, and this is how we prepare. But any uncertainty in terms of the nature god's behavior is unpredicted.
Okay.
So we are all ramping up, considering that yes, there is an uptick in demand and the industry is showing positive growth. Okay,
sir. But actually, looking at the numbers in this 9 months, so will we be? Already the enhanced capacity has been also there. So what can be the growth rate percentage terms at least that we can grow going ahead at least for FY25? Here our growth is a mirror of the way industry grows in one way, and then we make efforts to outgrow the industry growth by acquiring newer customers or making newer SKUs. So that's the general approach. But first of all, the industry definitely needs to grow. And current season, if we look at, as of 9 months ended, the entire industry has reported that yes, they are sitting on a position where they are not carrying much of inventory. And so going forward for the next 6 months, whatever fresh manufacturing will happen for the sales in the current season. So that's the positive signal. And as a thumb rule, I can tell you the industry is looking at close to 15 to 20% minimum growth for the coming season. Because that's the result of the previous 9 months. The 9 months to last year 9 months, the industry has already shown positive signals of growth. Okay, sir. So if industry grows by 15 to 20%, can we match or even we can outperform the industry rate, sir? That's our approach. That's the way we are making our strategies, that we should outgrow the industry. Okay, sir. Got it. Thank you, sir. That's it from me. Thank you.
Thank you. Participants who wish to ask questions may please press star and 1. The next question is from the line of Jan Thakkar from Ashika Institutional Equities. Please go ahead.
Thank you, sir, for the opportunity once again. Sir, I would just like to have a clarification. You said the order book is going ahead by 30 to 45 days. Sir, in the Q4 we have already passed 1.5 months now. How is the response from the brands now, and what are they saying for Q1 of next financial year? Can you give us some color on the order book of your RSA business?
Yes, okay. What I meant was, in general, the uptick or the uplift in the demand on a normal year, or in the historically it has been a manufacturing season starting from mid of November or starting of December to May. This year we see a slight shift in that demand ramping up. So this year it has been shifted by almost 30 to 45 odd days. That means from mid of January we have seen the ramp up in demand, which normally happens 30 to 45 days earlier in the, which has happened 30 to 45 days earlier in history, historically. So then, having said that, it means the capacity utilization in this since January to June are the period wherein almost 100% of capacity gets utilized.
So, but then still I'm not able to understand how is the order book now? So for the Q4, is it stronger than the last year's quarter, or is it spanning or spilling over to next quarter once again, or are they delaying more towards the next quarter?
So both. Definitely Q4 for this financial year is stronger than the last year, and at the same time we see a lot of currently the projections spanning till even June. It's traditionally it is till May, so yeah, definitely Q1 is also looking to be much better as compared to the last year Q1.
Okay, sir. Thank you. And sir, can you just help me out with one number? How many clients are you serving right now?
In air conditioner, overall for both AC and SD put together, we are serving more than 25 larger customers or known brands. Then there are probably another 10 to 15 smaller brands as well. But yeah, known or larger customers, overall 25 customers is what we are servicing as of now.
Okay, sir. Okay, thank you.
Presentation, you will see a list of almost close to 22 odd customers, named brands already there.
Okay, sir. Okay, thank you.
Thank you. We would like to remind participants that you may press star and 1 to ask questions.
In case there are no questions, we can.
The next question is from the line of Amit from CES. Please go ahead.
Hello.
Yeah, Amit.
Yeah. So thank you for the opportunity for asking the question. I have a small question that can we see the operating margins increasing on YY basis? As you had said, the order books of Q4 are also stronger.
On Y-on-Y basis, if we look at the operating margin, it has improved from 13% to 15%.
Okay.
And on a quarter-on-quarter basis, if we look at it, so last year quarter it was 11%, whereas this year same quarter 4 it is 17%.
All right.
The numbers are there in the investor presentation.
Yeah. Thank you.
Thank you so much, Amit.
Thank you. I now hand the conference over to management for closing comments.
So thank you all the participants in this earnings con call. I hope we have been able to answer your questions satisfactorily. If you have any further questions or would like to know more about the company, please reach out to our IR managers at Valorem Advisors. Thank you so much. Thank you once again.
On behalf of EPAC Durable Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.